This is an overview of Chapter 16, Business Entity Selection and Taxation. So we talked briefly about business entities, but we're going to talk a little bit more. So there are corporations. There are two types of corporations. One is an S corporation and one is a C corporation. Both have stock, but we're going to talk about the differences. There's a lot of restrictions on S corps, but it's a pass-through entity, so it can be taxed like a partnership. Then there's partnerships, which are unincorporated businesses with two or more members, or there's general partnerships, limited partnerships, LLCs, and LLPs. An LLC could be a partnership, or a single member sole proprietor LLC is an incorporated business with only one member. Only certain states actually allow single member LLCs, but that is allowed in Massachusetts. So sole proprietors are unincorporated businesses with only one member. If you add another member, you're automatically a partnership, even if you didn't formalize any agreement. So here's what the selection criteria that people determine. I do a lot of work consulting with businesses about entity setup and what's the taxation, and exit strategy is part of this. So you kind of have to know, like, how long are you going to keep this business? Is there an exit? Are you trying to raise capital? What type of entity is this? How do I get paid? All kinds of different questions. So ease and cost of formation is one of the criteria, the complexity of management and governance, the transferability and dissolution, the liability protection, and reporting requirements and taxation. So a sole proprietor. Let's talk about advantages and disadvantages. It's really easy to form. You basically operate. A lot of times you just file a business license in their city. Then it's simple to operate. It's easy to sell the business assets. There's very few administrative burdens. And income is what we call pass through to the owner on the form Schedule C for your 1040. So you don't have to file a separate tax return, just a separate schedule on your personal taxes. The disadvantages are there's limited ways that you can get money. You have unlimited liability. So if something happens while you're working in that business or you're doing that business and someone sues you, they can attach to all your personal assets. There's no guarantee of continuity. So if the sole proprietor dies, the business ends. And the business income is all subject to self-employment tax. Well, let's talk about a general partnership. So some of the advantages are there are more sources of capital than a sole proprietorship. There are more management resources available than proprietorships. There's less administrative burdens than corporations, and income and losses are passed through to partners. Problems with this, though, the disadvantages are transfer of interest is much more difficult than a proprietorship. Unlimited liability, so this is if you have a general partnership. Partnership tax and basis rules are complex. The net income is subject to self-employment tax, and partners are entitled to few tax-free fringe benefits that are generally available to employees. So let's talk about limited partnerships. The advantages of a limited partnership is that you still file a partnership tax status, which is pass-through. There's flexibility in the structure of the ownership interest. Limited partners are not personally liable for the debts and obligations of the limited partnership. So you're only responsible or at loss of what you put in. Disadvantages, you must file with the state to register. Limited partnerships may not engage in management. Limited partners, so if I'm a limited partner in the limited partnership, I cannot engage in the management. So there's usually a general partner that's the manager. And losses for limited partners are considered passive losses, therefore only offsetting passive gains. Limited liability partnerships, or LLPs, is a pass-through tax partnership status, which means, again, we're filing a separate tax return, but we're then passing the income through, which will end up on the 1040. So there's not separate corporate tax is what that means. There's flexibility to the ownership interest. Limited partners are not liable for the debts and obligations of the partnership, and partners can insulate themselves from the acts of other partners. You'll see this in law firms, potentially CPA firms, because I don't want to be liable for my other partner's acts. You must file with the state to register. Transfer of ownership may be restricted to similarly licensed professionals. So, like I said, it might be that in order to be a partner, you must be a CPA, or in order to be a partner, you must be an attorney with a law, the ability to practice law. And then you have unlimited liability for your own malpractice, usually by insurance. Then there's such things as family limited partnerships. So the advantages of this are control retained by senior family member. There's a valuation discount available. There's an annual exclusion gifts may be used to transfer interest. There is some creditor protection. There are restrictions that can be placed on transferability of the limited partnership interest, and it's usually used as a strategy as a part of estate planning. So disadvantages are there are attorney fees and costs, there are periodic valuation costs, there are operational requirements, and potential IRS challenge regarding the valuation and discounts. So when estate rules change, that changes the need for this. Recently, the estate rules, the credit had been increased, and so therefore you'll see less of these formed because people aren't trying to have the valuation discount available. Let's talk about LLCs. So this is the most frequent type of company I see for startup companies or people trying to limit their liability. So all members have limited liability and can participate in the management. So that's a real benefit. The number of members are unlimited. You can also have multiple classes of ownership, so that gives a distinct feature to an LLC. Single-member LLCs are disregarded entities for tax purposes. If you have a single-member LLC, it's basically filing on a Schedule C, just like a sole proprietor. Now, if members can be individuals, corporations, trust, or other LLCs and other entities. So you have two choices. It's either a partnership taxation, or unless a C or S corporation status is elected, or if you're a single member, it's just a disregarded entity and you file a Schedule C. Distributions to members don't have to be directly proportionate to membership ownership, and they may have limited life. So an LLC may have a limited life. Transfer of the interest is difficult and sometimes limited by the operational agreement. Some industries or professions may not be permitted to use LLC status. Partnership tax rules generally apply. Laws vary from state to state regarding LLCs, and the laws are relatively new. Therefore, court precedents cases are limited. Members not meeting exceptions are subject to self-employment tax on all earned income if the partnership is elected. So that means instead of flowing through the money and only some of it being taxed as self-employment tax, it's all taxed for the majority of these partners. A corporation. So what are the advantages? They're relatively easy to set up. And one of the reasons people choose a C corporation is if they're going to potentially have sell stock in order to, or transfer ownership interests. So that's one of the reasons. Shareholders have limited liability. A C corporation has an unlimited life. And there's more extensive management resources, and shareholder employees may receive a full array of employer-provided tax-free benefits. Some disadvantages. So there's double taxation. This is still true, but the corporate tax rate in 2018 was reduced to 21%. So that made people consider, how can I get a C corporation? Is that more beneficial? And that depends on, the pass-through and your personal tax rate compared to a corporate tax rate. It also depends on how you're going to liquidate assets, because if you're trying to hold real estate, you wouldn't want to hold that in a C corporation. Dissolution can cause taxable event. Borrowing may be difficult without stockholder personal guarantees, depending on the size of the C corporation and their prior income. Requires a registered agent and requires a federal tax ID number. So why might you be an S corporation? This is a specific type of corporation. You're electing the S status. So income is passed through to shareholders for income tax purposes, which means there's not double taxation. Shareholders have limited liability, and distributions from an S corporation are exempt from payroll tax if a shareholder employees are adequately compensated. So what they say is that you must have a reasonable salary at an S corporation if you're working there. And then the rest of the money isn't self-employment tax. I see a lot of dentists and that type of, or electricians or people who are working in the business but also have a bunch of employees. I see a lot of that make an S election. Some of the disadvantages are that there's a limit to 100 shareholders. So if this was a publicly traded, it wouldn't be an S corp, right? It wouldn't be anything like that. Only one class of stock is permitted. So a lot of times I'll see medical practices held differently, and they will be in LLCs because they allowed more than one class of ownership where this does not. You can't have any corporate partnerships, certain trusts, or non-resident alien shareholders on an S corp. Shareholder employees owning more than 2% of the company are considered to be self-employed for fringe benefit purposes, and borrowing may be difficult without stockholder personal guarantees. So an S corp versus an LLC. So this is usually the question I get. Double taxation, neither of them have it. A pass-through tax losses, they both have it. Availability of preferred return for certain investors, one class of stock in an S corp. No to the S corp, yes to the LLC. So preferred return is a way you can structure returns in the LLC that you can't in the S corp. Partnerships, corporations, and trusts can be entity owners. No to an S corp, yes to an LLC. You can have foreign investors in an LLC, but not an S corp. The availability for transfer interest in estate planning, no in an S corp, yes in an LLC. Low filing fees. An S corporation in Massachusetts and an LLC have the same filing fee or very similar. S corps have a different tax, so it's not significantly cheaper to have an LLC or an S corp in Massachusetts. They're similarly priced. Self-employment tax is really the reason that I see S corporation status. So election. So a self-employment tax on all income from owners and employees. No. So you could earn money and then the rest of the money, take a salary that's reasonable, and the rest of the money can flow through without self-employment tax. But on LLCs, it's generally self-employment tax. Limited number of owners, no to the yes for an S corp, no for an LLC. Owner's basis for deductible losses includes pro rata share of loans and by third-party entities. No on the S corp, yes on the LLC. And the law is well settled pertaining to entity. The S corp has been around much longer, and the answer is no on the LLC. And the filing date with extension is now September 15th for both. So here's a chart of the total comparison. So cost to create, low, medium, high for sole proprietor, partnership, general, and LLP. The liability, annual filing requirements, maximum number of owners. Owners are known as partners, owners. So where are they going to file? On a sole proprietor, it would be a Schedule C. On a general partnership, it would be a 1065, and K1s flow through to a Schedule E. Limited partnership, it's a Form 65, K1s flow through, and an LLP may file as a corporation or a partnership. Now, if we're talking about family limited partnerships, LLCs, S corps, and C corps, so the cost to create are all high. Personal liability of the investors is no except for a family limited partnership. They all require estate filing on an annual basis, and only an S corp has a limited number of owners, and they are known in an FLP as a partner or limited partner, member, shareholder. And their filing status. So an FLP is a 1065. For an LLC, if it's a single member, it's a Schedule C on the 1040. If it's two or more, they choose partnership, S corp, or C corp. So it does flow through. And then on an S corp, it's an 1120S and a K1 to shareholders. And on a C corp, it's a Form 1120, and it doesn't flow through. They would get a W-2 or dividend income if there were distributions from the company. So talking about corporate tax rates, so the Tax Cut and Jobs Act of 2017 lowered the corporate tax rate to 21%. But in order to try to even the playing field so people wouldn't just try to become a C corporation all of a sudden, they have what is called the QBI, Qualified Business Income, is subject to a 20% deduction for some pass-through entities. So here are some of the basic rules of the Qualified Business Income deduction. So basic rules were covered in Chapter 7 for individuals owning only one pass-through entity. It's available regardless whether the taxpayer selects the standard or itemized deduction, and it's to create parity in the tax treatment of a pass-through entity versus a C Corp. When taxpayers own more than one qualified business, they must first calculate the deductible QBI for all businesses, and then net the amounts together to determine a combined QBI. The deduction is the lesser of the combined QBI, or 20% of adjusted taxable income, excluding net capital gains. So let's talk an example. Jerry's share of qualified business income from each of his two partnership interests. Partnership A is $30,000 and B is $40,000. His deductible QBI from each is 20%. So 20% of 30, which is $6,000, and 20% of 40, which is $8,000. Jerry's combined QBI is $14,000. Jerry from the previous slide is single and has adjustable taxable income from all sources after taking above-the-line deductions and whether either the standard or itemized, but before taking 20% QBI, is $130,000, of which $10,000 is net capital gains. Jerry's QBI deduction is the lesser of the combined QBI, which we calculate on the first slide, or 20% of adjusted total taxable income, excluding the gain. So the gain was $10,000, therefore it's 20% of 110, 20% of 120, which is $24,000. So Jerry's deduction is the combined QBI of $14,000. So QBI is phased out. Based on taxable incomes from all sources, including spouse's income if married filing joint, excluding the QBI deduction, the married filing joint phase-out amount is between $321,400 and $421,400 for 2019. All others, so it's either married filing joint or everybody else, is $160,700 or $210,700. Taxpayers below this threshold are not subject to phase-out rules. Taxpayers above this threshold are subject to the phase-out rules, which are W-2 wage limitation or specified service trade business limitation, SSTB. So the SSTB basically says if you're in a specified service trade or business, which is professional services, lawyers, doctors, dentists, healthcare, engineers are exempt, architects are exempt, CPAs, accountants, I think I've named the majority of them, but there's a whole list in Chapter 7. So you would then go to that secondary calculation, which was covered in Chapter 7. We're not getting too detailed into QBI. This is a very new, and a lot of tax research is required. And that's the overview of Chapter 16.